Welcome, chumps. Welcome to the Chump Change Trader channel, and I'm your host, the Chump Change Trader. We finally have access to our liquidity, and we placed our first trade, two actually, and we'll get into that. But for the first thing, I want to sort of walk through what happened in the market today. So today is March 20th, 2023, and for the most part, the markets were kind of chopping sideways. It was green for the most part, and definitely kind of a weird one to trade if you were doing any day trading. But most indexes came out in the green. The Dow did move slightly different than The Dow did move slightly different than every other index. So that was just only the slight difference between there. But for the most part, everything was pretty decent markets in terms of a market situation. And in terms of banks, all banks were green except for FRC, which dropped 47% as of close, with a little bit of trailing at the end. So, youch. But if you knew what you were doing, you could have taken full advantage of that volatility as well. And so with that, we want to sort of walk through, I guess, what is causing sort of this movement right now. I would say, in my opinion, it would probably have to do with the fact that we have the FOMC meeting, an announcement coming up on Wednesday, and obviously everything in the news right now is talking about the regional banks and Credit Suisse. And so Credit Suisse just recently announced that they are getting a buyout by, I believe, UBC. And so they will be bought pretty much at, I believe the rate is at 85 cents per share. So for every 85 cents, let's do Credit Suisse right here. And you'll see that it is currently sitting at 90-ish cents right there. And I made a degenerate move over that I'll talk about a little later on that particular equity. But for the most part, the biggest news that everybody's sort of waiting for is the FOMC. FRC itself, First Republic Bank, they are in talks with, I believe, JP Morgan, and I think that's it as of now, to trying to see, what could they do in terms of injecting liquidity. So not a buyout, but liquidity injection. So that's a little bit of a different situation. Could be the reason why there's such a crazy sort of drop off in terms of what's going on with their stock. So we'll see. If you don't have that kind of stomach for that kind of volatility, well, then you might want to go and stick with your ETFs. And so I like a little bit of both, where I get some exposure to volatility, yet also being able to capture some of that, or at least protect myself with the fact that I would be in an entire market sector that probably wouldn't really necessarily get, completely rocked entirely. So that's one of the reasons why I've mentioned before, I stick with sort of semiconductors ETF. So without further ado, let's walk into sort of the two trades that we finally got to make. And then just a reminder of what the whole challenge is. It's a small account challenge where we're only putting in $2,000 in the account. And the rules are that the buying power cannot be over 70% of the account. So I cannot use more than 70% of the buying power on this account any given time. And I can't add any extra liquidity, which is a very, very tough and tall order to sort of try to trade with. And I wanted to sort of see if I could do this kind of challenge while being able to sort of, inspire and walk through people as to what they could do when it comes to options trading in particular. So our first trade, I've harped over and over again, is SOXX. And so making sure that I kept too close to what I initially was planning for my position wings on this iron condor. So an iron condor consists of two short positions, or just like a strangle. So it's a short call, short put, and then buying long call and put on the outer side to create a sort of a defined risk strategy. And the risk profile looks a little bit like this. So by the virtue of having my short puts being what makes me the credit, the long positions basically define any of the losses that I could occur if I were to be out of the money in this particular situation. And the base and that's pretty much it. So I set it for 30-ish days, well in this case 32 days to expiration, DTE, days to expiration. And I netted for this particular trade, let's look at this right here, activity filled. I netted a $240 credit for that. So $240 or $2.40 for that position. So $240 went right into the account. And so you may not see that account because the account value doesn't necessarily track cash, so to speak. It's only tracking my buying power and my net and my buying power and my actual account value with the positions in it. But you'll see it sort of break down right here. So you have the cash right here. I started with 2,000, went ahead and got filled for that 240. So it put 240 into the account. The position itself over time from when I posted it midday of today was a net loss of $15. And then I also put in a Credit Suisse long position for basically 669 days out at a 50-cent strike price. So that was sort of my degenerate move there. Excuse me. And so yeah, those are the two positions. Not much. I mean, a slight move has been made since I put the position on. The price was probably roughly around 420, and then now it's at was it 420? It was like 425 when I put that position on, and then it moved a few dollars over. It moved approximately $5 over into this position. So the idea is that we want to be able to capture the price within the iron condor itself and hope that in 32 days from that point on it will stay still. Now, knowing that there's huge amounts of binary events that are going to happen, especially coming on Wednesday, this was a particularly risky move, but at the same time I also wanted to stay true to what I wanted to open in terms of position prior from the start. So that's part of trading in general, that's part of investing in general, that there will always be events that will happen, over the course of time that may skew your positioning and in terms of your favorability on a position. So that's where sort of the position management really comes into play. So the difference between options trading versus, let's say, buying and selling stock is that when you buy that stock, your only anticipation and expectation is for that stock to go up. So you realistically only will be able to benefit and profit when the markets are moving upwards. In options trading, you can tailor make your profitability however you decide that, or however you determine the path of what the market is going to move. So from that point in perspective, it gives you a lot of flexibility and power as to how you can define what's going to happen and how you're going to make that money. There are lots of different things. I actually contemplated changing this into like a broken wing butterfly or a jade lizard, just for the sake of being able to capture some upside or downside movement. But I also wanted to, again, stay true to what I wanted to employ in terms of a strategy. The next position may just be exactly that, so that we can capture some upside downside protection with a different position and how that looks like. But for the most part, sticking to this for the time being, as we test or move towards one of the two goalposts, so to speak, we will then consider what strategies and what kind of things that we can do. But for the most part, a defined risk strategy where you have both of the risks having a maximum kind of risk profile. So the most that I could lose would be a $240 loss, right? Sorry. Yeah, the most that I could lose would be $260 at expiration. So in those situations, you're basically gambling $260, right, of your own buying power to make $240, which is closest as I could get it to 1-to-1, which is not bad. So that's why if you look at my wings on my position where I picked 395 and 390 and 450 and 455, the 450 and 455 is actually the same from the previous position that I did in the other account. But the 390 and 395 has shifted upwards more, primarily because since the stock price has been moving higher, or rather, I wasn't being able to capture the same kind of level of 1-to-1 or closest to 1-to-1 profitability to buying power ratio as I was when I previously intended to actually start that position. So yeah, so that's sort of the reasons why I moved it $5 upwards, because I believe I had 390 and 385 as my put positions on this Iron Condor. So for these types of positions, most of the times your only option in this situation is to just let it run its course. And from the analysis that I have done for the past, I'd say, looking at it from like a month perspective, 430, if you look right here, has been always tested as a resistance point. 430 right there in 1 month time span. Let's look at 3 months. Hopefully it'll fix itself. 438 was the highest right here, but let's just say across the board, 430 is really pretty much the highest that SOXX has been really reaching in the past 3 months. So given that resistance point was one of the reasons why I chose that field goal and giving myself some more wiggle room and buffer, 450 seems to be pretty reasonable enough, even if there's a huge swing upwards. From 430 to 450 is pretty substantial enough jump. But given that we're only a month out and we're looking at it from a 3 month time period, we should be okay. And then from the downside protection, the 393 and 390, pretty much like just below 400 is really sort of that area of support right here. So area support at 400 right here, and then area support at 395. So literally matching those up. So where I lost a little bit of extra buffer room in terms of a downside protection, I think it should be okay, considering that, you know, majority of the trend in the last week or so, let's do 2 weeks, has been really trending towards the upside. So my more concern is that this will run away and run towards the north side despite all the market conditions, because you never know what could happen. But dealing with a market pullback is not too concerning, considering that without sort of major news in the semiconductor space, even though the NASDAQ tends to move semis, I should be okay in that regard, especially for a month's time period. If I was going to make a much longer time period, I would want a less volatile kind of equity to really sort of gamble an Iron Condor on. So that's just sort of my 2 cents there. And then, of course, let's look at my degenerate move in Credit Suisse. I decided, why not just buy a 50-cent call 669 days out for Credit Suisse. And of course, I put this on right before I knew about the news that UBC basically had bought them out. So at that particular point, I was like, oh, okay, well, basically this will be traded in at the current trade price of what has been agreed upon. So this is 85 cents. I will basically just make the difference between 85 cents and 50 cents on this particular trade price. Actually, I'm wrong. In terms of what it would be, is that it would trade at 85 cents, so it would be at the loss. So I'll probably close this position since that news came out, and I won't really lose too much because this is a long position.